One more step and I'll be in the black. That thought sounds like salvation, but in reality, it's a sentence. Because every next step in Martingale is always more expensive than the previous one. And one day, it will cost more than your deposit. If you turned on this video, chances are you've already had that day. The increase bet button, trembling hands, a racing heartbeat, and an empty account. I've been there too. Today, no myths or pretty promises. Martingale doesn't save you, it destroys you. And I'll show you why this isn't a matter of luck. It's the math of your future with a zero balance. What is the Martingale system? To put it simply, it's a system where you double your bet after a losing trade. A system that can be easily, in practice, integrated into any trading strategy, any method of finding entry points, and into the mind of any beginner trader. Its versatility and simplicity have made this system extremely popular by traders worldwide. Millions of traders around the world use it. But there's a catch. 95% of people who come to the market inevitably lose their money, and almost all of them trade using the Martingale system or other similar strategies. It all starts out simply. Due to a lack of knowledge and experience, people tend to look for information on the internet, including from more experienced colleagues. The main motivator is money. Everyone gets into trading to make money, not to lose it. But how can you do that if the market is a very complex structure and it's simply impossible to always make the right predictions? That's right, you need to trade in such a way that any possible losses are covered by the profits you make. This is where Martingale comes onto the scene. At first glance, it all seems very simple. You open a trade. If your prediction turns out to be wrong, it's no big deal. You double the amount and open another trade. And again and again. Sooner or later, a trade will close in profit and recover all your losses. You go back to the beginning and the cycle repeats. As a result, you haven't given any of your money to the broker and even made a little profit. Sounds great, right? Basically, it delivers exactly what you came to trading for. You make money, and at the same time, you don't lose anything. That's exactly why millions of traders use the Martingale system. The strategy is very easy to use. You don't need much knowledge to double your bet and open another trade. The system is universal. You can use it in combination with any strategy. It really doesn't matter at all what specific approach or method you use to find signals. You can actually double your bet anywhere. Martingale always gives you hope. You'll only be making money, and any possible losses will be covered by a single profitable trade. It even seems like the math is on our side. Two outcomes. It's like flipping a coin, heads or tails. A series of losing trades can't last forever. Sooner or later, the market will give the opposite outcome. And when it happens, one profitable trade will recover all previous losses. That's how the law of large numbers works. Over time, everything tends toward 50-50. It seems like what more do you need to make money in trading? All the conditions are set, just go ahead and trade. But in reality, time after time, almost without a chance, you steadily lose one deposit after another. You didn't even notice how you already got hooked. And right now your money is being divided among interested parties. Who are they? Of course, the broker you're trading with. Most binary options, Forex and CFD brokers make money from your losses. To them, you are a desirable client who will come, spend your money, and get nothing in return. The second party interested in your loss is the blogger who taught you to trade using Martingale. How did that happen? You got fired up with the desire to start making a lot of money quickly online. The reason doesn't matter. For example, I dreamed of financial independence and the ability to work for myself. Just like you, I went looking for a way to make money. And lo and behold, there it is. Some stranger clicks a couple of buttons and makes as much as I couldn't earn in a year. It's really hard not to get infected by this. You have no knowledge, no experience, but you really want to try. There's only one way out, to borrow experience from those who are already making money. You watch one video, then another, then a third. It's the same thing everywhere. Open a trade. If there's no profit, double up and open again. The result, a very rapid increase in your balance. It would seem that the majority can't be wrong. The information is confirmed by various sources. It's worth trying. You register using the link, top up your balance, do everything exactly as shown in the video, and that's it. Your balance is zero. You repeat everything again. And the result is always the same time after time with no changes. It's a shame that no one told you that the blogger who taught you to trade using Martingale, just like the broker, is also interested in making sure you always lose and never make money. They convinced you to use a method that can drain deposits of any size. Even hedge funds with millions of dollars in their accounts literally lose everything. So what are you doing there with your $100? But by the time you're watching this video, your deposit is already gone. You didn't just click on this icon for no reason. Your soul is craving the truth, and I'll do my best to give it to you. To understand the reason for your failures, you first need to understand what profitable trading actually is. If you ask a beginner trader what the most important thing in trading is, they will answer without hesitation: the strategy. The more profitable trades you make, the more you earn. But if you ask the same question to an experienced trader, the answer will be different. Moreover, every trader will have their own answer, and later you'll understand why. Imagine a pyramid. It consists of several parts. To start trading profitably and consistently, you need to fill in all the cells. Let's start from the top. A strategy is your method for finding signals. It doesn't really matter whether you trade on a clean chart, use indicators, analyze news, or even open trades at random. Everyone trades in a way that's comfortable for them. No one will ever judge you for that. But strategy is just the tip of the iceberg. At most, it accounts for 10% of your trading success. Do you have any guesses about what else your profitable trading should consist of? Most likely, you don't have an answer to this question. Yes, you might understand how price moves, how to read candlestick charts, how to interpret indicators, and much more. But what difference does it make what you know if the result is always the same? All your trading is just a strategy you found somewhere on the internet, wrapped in a Martingale system like a candy wrapper. And you still expect to make money from this? Okay, we figured out the strategy. That's the top of the pyramid. But what holds up the roof? The foundation and one of its most important pillars is trading psychology. That's about 30% of your trading success. It would seem that we came here to make money. How can a social science help us in a world of numbers and charts? The problem is that you, just like I once did, came to trading with a very limited amount of knowledge, which there was simply nowhere to get. They don't teach us this in school, but ignorance doesn't free you from responsibility. Trading psychology teaches us to control our emotions while trading. You've probably already noticed that the best results come when there are absolutely no outside worries or distractions. It's just you, the chart, the trade, nothing extra. Trading goes smoothly, the outcome is predictable, and more importantly for you, positive. Emotions are a trader's worst enemy. Just like in real life, emotions push us to make rash decisions. And it doesn't matter whether we're angry or laughing, the emotional background still knocks us off our usual track. It's the same in trading. As long as you stay calm and focused, everything will work out for you. It's like walking a tightrope over an abyss. If anger and despair outweigh you, you'll fall to the left. If joy and overconfidence take over, you'll fall to the right. The only way to make it to the end is to feel nothing at all. Trading psychology teaches you to control your mind and to look at familiar things from a different perspective. For example, any experienced trader knows that losing trades are part of profitable trading. You can't hide from them. You just have to accept it as a fact and keep trading. Another important aspect of trading psychology that deserves special attention is fear. Fear doesn't come out of nowhere. There are actions that give rise to it. Why are some people afraid of the dark? They are not afraid of the absence of light itself, but rather of what the darkness may be hiding from them. Fear in trading works exactly the same way. You're not actually afraid of the open trade itself. What you're really afraid of is losing the amount of money you've already put in. In trading psychology, there's a very important and fundamental rule: 3 shots and stop. If you have 3 losing trades in a row, it can trigger a defensive reaction in the brain. I start losing too much, the situation gets out of control, and I need to do something urgently. This is when you start to rush. Rushing often leads to impulsive actions, poor judgment, avoidable mistakes, and potentially losing money. 3 losing trades in a row throw you off balance. Where it used to be just you, the chart, and the trade, now there's a desire to win back losses, frustration and anger, maybe even fear. The Martingale system is designed in such a way that a series of losing trades is not a problem for it. Moreover, the rules of this system convince you: just wait out the losses and you'll make money. Yes, a losing streak is not truly endless, but it can, in reality, last much longer than you might be able to remain solvent as a trader. Always remember, experiencing 10 consecutive losing trades does not guarantee that the 11th trade will be profitable. The Martingale strategy can take a trader from a calm and composed state to uncontrollable rage in just a few trades. It goes without saying that by the 4th or 5th trade, depending on the size of your trading balance, it's no longer possible to analyze the market rationally. It's impossible not to be afraid of a trade that could take away half of your trading balance. At this point, it's either pure luck or a complete wipeout of your deposit. The very concept of trading with the Martingale strategy doesn't allow you to trade with a fixed stake. You are forced to risk a large part of your deposit, and because of that, you can't maintain a stable psychological state. If the trade closes in profit, there's joy, euphoria, and sighs of relief. And all of this lasts only until a new series of losing trades appears, which not only takes away your earnings, but also wipes out all the money in your trading balance. So, who is to blame in this situation? You allowed this to happen to yourself, so you are the one to blame. Risk management. The best way to limit your losses is to follow risk management rules. Risk management is literally the skill of managing your capital. This is another fundamental part of profitable trading. Everyone comes to trading to make money. But the difference between a beginner and an experienced trader is enormous. Beginners see how much they can actually earn. Experienced traders see how much they can potentially lose. Risk management is a set of strict rules that allows a trader to stay in their comfort zone, not lose too much, and not give back to the broker what they've already managed to earn. As the name suggests, the main objective of risk management rules is to effectively control and manage risks. It's impossible to keep trading if you lose your entire balance in a single trade, so it's important to follow a few rules. Trade with an amount that does not exceed 1 to 2% of your trading balance. Even after a series of losing trades, you won't lose too much, and the impact of emotions on your trading will be minimal. After 3 to 5 losing trades in a row, you should take a break. Even experienced traders go through periods of losses. Consistently closing trades at a loss happens when you misunderstand the market situation. It's better to wait it out. You should only trade with a fixed stake. This is the only way to avoid emotional stress. Moreover, when trading with this method, it's very difficult to lose your entire trading balance in a single day. You need to set a loss limit. A threshold is needed for those times when your trade results alternate but your trading balance is gradually decreasing. There's no reason to lose too much when trading is going badly. A profit limit is necessary to avoid overtrading and to get rid of unnecessary emotions. It's also worth setting a limit on the number of trades, which will further restrict your trading and have a positive effect on your balance. So these are logical and useful rules, aren't they? Now, let's analyze the Martingale system from the perspective of proper money management. The Martingale system forces you to start trading with the minimum amount, but if a trade closes at a loss, it requires you to risk increasingly larger amounts, up to betting your entire remaining balance. A series of losing trades does not lead to stopping trading. On the contrary, a significant amount has been lost, which you now need to recover. Trading continues until either a complete win or a total loss of your balance. There is no way to trade with a fixed stake. You are constantly on an emotional roller coaster. You can forget about calmness and focus. Your loss limit is your entire trading balance. There is no profit limit. In lucky moments, the Martingale system allows you to earn large sums. But there can be no talk of any stability. Today, you might multiply your balance many times over, but tomorrow you could lose everything and even end up paying more. There is no limit on the maximum number of trades. Emotional tension won't let you stop in time. You are always haunted by the feeling that you need to win back your losses or earn even more. Trading continues either until you lose your balance or until you burn out emotionally. Trading using the Martingale system is the complete opposite of sound risk management rules. All risk management rules are aimed at preserving your trading balance. The Martingale system essentially forces you to make a choice between win or lose everything. Risk management rules are like a map of the terrain, but the map won't walk the path for you. Between knowing and doing lies one thing: trading discipline. It is discipline that makes you stop trading after the third loss, close the terminal when you reach your daily limit, and not give in to emotions. You, like any other trader dreaming of making money, must be able to follow the rules of your trading strategy, adhere to risk management rules, and avoid opening trades where you shouldn't. There's a good saying, it doesn't matter whether you're right or wrong. What matters much more is how much money you made when you were right and how much you lost when you were wrong. So, trading is built on whether you can always take the right actions regardless of your current results. Can't you? Your trading will end up like a game with a sad ending. Can you? Here's your money. Take as much as you can carry right now, if you want. Discipline is the link between trading psychology and risk management. It's like the cement between building blocks. Either it's there and the structure is strong, or it's not, and everything will fall apart at the first gust of wind. There is no third option. Discipline, first and foremost, is aimed at making sure you earn consistently. The Martingale system, on the contrary, makes you undermine your trading psychology, break the rules of your trading strategy under the influence of emotions, and violate risk management rules when you want to win back losses. Emotional swings prevent you from objectively assessing the market situation. Martingale here is not just bad math, it's a slow corrosion of discipline. It teaches you to break the rules precisely at the moments when you need to follow them most strictly. Trading psychology, risk management, and personal discipline together make up about 90% of your overall success in trading. If you ask experienced traders which of these is the most important, each will give their own answer. They'll put first what was the hardest for them to master. For me, that's trading psychology. To be honest, I'm tired of riding this emotional roller coaster that the Martingale system put me on and didn't let me off for more than 2 years. After something like that, you need a long and hard recovery. So we've broken down what profitable trading consists of and how the Martingale system negatively affects all the key aspects of trading. It might seem like it's time to say goodbye, but not yet. I can already see you getting ready to write in the comments that you can trade using the Martingale system if you're careful. For example, if you open no more than 3 trades. Well, let's break down this option too. To finally drive the nail into the coffin of Martingale as a profitable trading strategy, I suggest turning to mathematics and probability theory. In trading, long streaks of losing or winning predictions are normal. But the thing is, if you trade with a fixed stake of $1, after 3 losing trades, you'll only lose $3. But if you start trading with the Martingale strategy from the same amount, your loss will be about $7 to $8 depending on the payout for a correct prediction. At first glance, it seems safer, since endless doubling really does kill your deposit. But let's take a look at what actually happens. Every streak of 3 losing trades in a row is essentially your reset point. If your strategy doesn't have a mathematical edge, the probability of such streaks over time becomes not a matter of if, but when. Yes, limiting yourself to 3 steps reduces the risk of a total wipeout, but it also kills the main idea of the Martingale strategy, to win everything back with one successful trade. Now you don't recover your losses, you only partially compensate for them, and slowly but surely you lose your balance. The math here is simple. Without a positive expectation, Martingale isn't a strategy, it's just a form of delayed loss. 3 steps is simply a softer path to the same outcome. The risks? A losing streak can happen much more often than you think. Your deposit won't disappear suddenly, but gradually, creating an illusion of control. And the most dangerous thing is that you'll start to believe the system almost works, and you'll raise your bet. So Martingale with limitations is no cure-all. It's just a compromise between fear and excitement. And in the long run, the winner isn't the one who doubles down, but the one who thinks one step ahead. Let's add that risk management rules are often violated. For example, after 3 trades, you should stop. Remember, the Martingale system encourages excitement, greed, and the urge to win back losses. Sooner or later, you'll give in to temptation, and after the 3rd losing bet, make a 4th, then a 5th. It doesn't work that way. The entire Martingale system is always a game. There are a lot of emotions, sometimes you hit big wins, but all this fun comes out of your own pocket. I don't even need to prove to you that the Martingale system doesn't work in trading. You'll realize it yourself. Just open your deposit and withdrawal history with your broker. How many deposits have you made and how much have you withdrawn? Just think about it. Nevertheless, Martingale has one advantage, just one, but a significant one. It allows you to recover all your losses with a single profitable trade. It almost sounds like magic. You suffer losses, but then one precise move and everything is compensated. But behind this magic lies a long list of drawbacks. And this is where reality begins. First of all, the risks are enormous. Each time you double your bet, it's not a step toward profit, but toward the edge of a cliff. You might feel in control, but that control is already slipping away. Second, you need a huge deposit. Without it, Martingale simply doesn't work. A few losses in a row and your account is wiped out. Third, a complete violation of risk management rules. All the rules that keep traders alive are broken, and this is where psychology starts to crack. You stop being a trader and become a gambler. Every decision is emotional. Every trade is a battle not with the market, but with yourself. And now, the most interesting part. Doubling down is actively promoted by brokers and those who profit from your losses. It's in their interest for you to believe that Martingale is an opportunity. In reality, it's a trap wrapped in pretty mathematics. Even a limited form of Martingale where you stop after a couple of losing trades still ends up losing because the market doesn't care about your statistics. Then comes a false sense of security. It seems like the system works until that very streak of trades comes along and takes everything away. And you're left not only with an empty account, but also with exhaustion, disappointment, and fear of returning to trading. Martingale isn't a strategy, it's a test of endurance. How many times can you double your bet before your stress doubles and your balance hits 0? And that will definitely happen. I tend to agree with the majority of profitable traders. It's not worth trading with the Martingale system. There are just too many drawbacks. And the only advantage of this risk management system is far too weak to tip the scales in your favor. And honestly, it's funny to even call the Martingale system a risk management system, especially since this trading approach actually creates risks for the trader. Why am I against it? Reason number 1. These systems are actively promoted by those who profit from your losses, brokers and paid experts. It's in their interest for you to lose. If someone who benefits from your loss recommends a brilliant system, that's not a signal, it's a siren. Reason number 2. Professional traders earn with fixed position sizes and treat their balance with care. Doubling down after losses is a direct path to ruin. Reason 3. Statistics. 95% of traders lose their deposits and the lion's share do it using Martingale. Want to avoid being one of them? Stop doing the same thing. Reason 4. Personal experience. Almost 3 years of steadily losing money by doubling down. The turning point came the day I completely abandoned this approach. Reason 5. Risks and psychology. You're overwhelmed by emotions, you're no longer trading, you're taking revenge on the market. It's better to earn steadily and calmly than to crash out quickly and turn into a nervous wreck in front of your monitor. but this is what they teach you everywhere. That's right. So what should you do? Turn away and walk off. The sooner you stop listening to advertising promises, the more money and nerves you'll save. If someone is convincing you to trade using the Martingale strategy, then either they don't understand the risks or they're interested in your wallet. There are no other options and you won't benefit from such training. Yes, let me put it bluntly. How thoughtless do you have to be not to see the role of Martingale in trading? In all my years of practice, I have never seen a single experienced trader who consistently made money with Martingale. Not a single one. Now someone will recall their favorite bloggers, put them on a pedestal and say that I'm wrong. And I already know the reaction because those very bloggers are interested in your losses as long as you believe any nonsense they sell as the only true strategy. Open your eyes. No one is going to teach you how to trade profitably. No one. You're not a student, you're a source of enrichment. To them, you're expendable, just buy a waste in their sales funnel. The statistics are simple. Most people lose money. And how do they lose it if 99% of experts teach trading with Martingale? The answer is right in front of you. If you came here for easy money and are ready to listen to just anyone, the market will chew you up and spit you out. Do you have a brain? Use it. Learn one thing: independent trading. Send to hell anyone who is even slightly interested in your loss. And until that happens, you will keep losing everything to zero over and over again. There never were, are not, and never will be easy ways. Trading is hard, it's discipline, it's risk management and trading psychology. Neither Martingale nor signals will save you. The only person who can do anything for you is the one you see in the mirror every morning. The list of trusted people is closed. If you think otherwise, congratulations. You're already among the 95% who lose everything. I hope I got through to you. If not, I wasted my time. I believe that your common sense is stronger than the noise. I hope you succeed. But honestly, there will always be new people to take your place so that the statistics stay the same. Don't become part of that crowd. The choice is always yours to think and grow or to keep doubling down until you lose everything again.